This is Eric Mwatha with Mwatha.com going into the second week of March 2012. We see that the first couple of days, trading days of March, that the market did manage to push to close, touch intraday weekly highs going back about 3 years, all the way back 2008. We see that the market is still holding above the S&P 500 breakout point of 1363.61, which is where you'd like the market to stay above if it's going to continue with its breakout right here at 1363.61. As long as the market stays above that on the S&P 500, well, then we can always conclude that the market still wants to push higher. Any failure for the market to hold those levels, then we can start looking for the pullback that is, I think, imminent. It's gonna come just swiftly and probably with a surprise event. But anyway, so the market trying to hold above those breakout levels on the S&P 500. If you take a look at the S&P 500 from a daily chart, you'll see that this market has had a straight run. Let's say even beginning in December, we've really been trading in this very narrow range, absolutely narrow range, which really, if you look at it, is looks to me like a trap here. There's a pullback looming in this market here, even if it comes back to the 50-day moving average, but there's a pullback given this very steep continuous move to the upside that at some point is gonna see a trend change and the market's gonna see a pullback. How much of a pullback we're gonna get is really difficult to tell. We'll have to reconsider whenever that happens, given the chart formations we will have at the time. Now, if you take a look at the S&P 500 from a monthly chart, you'll see that the monthly breakout point, the highest monthly close going back to the beginning of 2011 was at 1363.61, and as long as the market is staying above that on the S&P 500 monthly chart, then this monthly breakout is still in effect. If we see a market fail to hold that level and push back below this price, then we really do have to consider that the pullback is now in effect. So those are some of the things we need to look at. Right now, still above that level, a few points above that. We'll see whether it continues with the breakout or if it's gonna give up the ghost and push higher. Now, I was taking a look at the monthly chart for the S&P 500, and what you see is that if you take the highs of the S&P 500, the highs in 2008, 2007, 2007 highs, and the highs in 2011 on the RSI, draw a straight line. You see that we are at that particular juncture where we're either going to stall or break out. So if we stall, definitely you want to turn negative on this market. If we break out, you want to continue playing quality individual breakouts in the market. But for now, this is a tricky point in the market. This line here could be where the market stalls, and if it stalls, it's going to be good for a serious pullback. Let's take a look at the Russell 2000, and this one is one of the few markets that never really made it to the to new highs. You can see the highs, 52-week highs were here, and it's been making lower, has come as much as a few points off the highs, never made it to fresh highs. And we also see that it's now pulling back. If you take a look at the RSI, you'll see that it's breaking below this red line here. So that's a break of a trend. That break there means that move, as far as sentiment is concerned, has been broken. And also you'll notice that the MACD has broken a trend here, also pushing the MACD below zero, which also suggests that this is beginning, or at least one sector showing that the market could actually be pulling back or starting to pull back in some areas. Now again, if you take a look at the QQQ, it's one of the most powerful charts you're going to see in the market. This is going to be interesting. Week number 1, 2, 3, 4, 5, 6, 7 weeks since it broke out above 59.32. That's a very powerful looking chart. Again, as long as it's staying above this 59.32 level, you really, even if it pulls back, this market is going to have a lot of momentum to the upside, just because this breakout with about 6 weeks of a follow through is absolutely powerful. Now again, I was taking a look at the Nasdaq 100 chart, and you see that this is again trying to work on a month number 3 after the breakout here. Very powerful movement. The only problem that I see is on the RSI front, and again this could be where the market comes into some serious trouble. Notice this area here on the RSI, this line here corresponds with this break in late 2007. This break here of this area here led to the crash of 2008. All right, and then we tried to move about this level here in early 2011 and failed. Once we failed, we had the pullback of mid last year. It was a serious pullback. So we are back at this level here where we could, if we stall here, it's going to lead to a significant pullback. And also, if you take a look at the highs, see that the highs here, 2007 highs, 2011 highs on the monthly RSI, and we are on the line right there. So we either stall and see a sell-off, or we break out and continue pushing higher. So we're gonna know here in the next couple of weeks whether this is a stalling formation or a breakout formation. If you take a look at the DJR, which is a real estate ETF, you see that on a weekly chart it failed to break out above those levels, and still consolidating its after this move here. It's still trying to consolidate, could have a chance in the future to break out again, but right now what we can say is that it failed to break out and is now in no man's land. What I was looking at on the RSI was a stalling pattern, which you see here. You see that the last pullback came when it moved below this level on the RSI on the weekly chart, and you see that that's where it stalled this time around. So this could be again another subtle sign that the market does indeed want to pull back. Now we take a look at gold, which is really had a huge one-day pullback, first couple of trading days of March, and it's a very odd setup here. But ultimately, gold is still trading above the 50-day and above the 200-day moving average. So despite that big move lower, gold is holding above its long-term trend lines of the 50-day moving average and the 200-day moving average. So it really, gold is not broken, but it's showing signs of wear and tear. It's very hard to make a decision whether it goes lower here until it breaks below the 50 and the 200-day moving average. The fact that the 50 and the 200-day moving average is where it's holding above could suggest that gold is gonna creep its way to the upside in the coming weeks. Now, if you take a look at the GDX, it's trading smack in between the 200-day moving average and the 50-day moving average. So it's really in no man's land. This is a GDX is a gold miners ETF, which always if it's breaking out, then you want to play the gold stocks. But right now, even the gold stocks look like they're going to be in trouble, or at least not in favor, because you see that as of recently, the gold ETF, gold miners ETF, is actually showing that there is resistance here. So can't move above this RSI top lines, which means movement to the upside is really limited. Now if you take a look at the dollar as seen by the UUP, you see that the dollar did actually find support on this line here, and you see it bouncing to the upside this week. So the dollar could be trying to make a recovery as far as the weekly chart is concerned. It's also trading now back above the 33-week moving average, and also trading at the 10-week moving average, which would be signs of a dollar that wants to move higher. If you take a look at the euro, you'll see that the euro having broken here, and if you can draw a straight line here, we've worked our way back to this area, stalled and pushed lower. So even the euro might be suggesting that the dollar goes up short term and the euro struggles for a while. If you take a look again at the euro from a RSI perspective, you'll see that the most recent rally stalled exactly on cue. this is where you'd expect the stalling to take place, exactly on the RSI top line. So it stalled right there, and since then it's been pulling back, which again suggests a euro that wants to go lower. Let's take a look here at the Dow again. So really net, as long as the Dow is trading above the breakout point of 12,810, you want to stay at least you want to stay bullish until that breakout fails. So this another level to watch is on the Dow. If the Dow stays above this level 12,810, which means the weekly chart is on breakout mode, you want to stay positive. As far as the USO is concerned, what I was looking at here as the USO, which also similar chart to the one for crude oil, is I'm looking at this as a potential stalling area. In other words, this might be as high as crude oil goes or the USO. You'll notice that this area, the yellow shaded area, connects to the highs here, and most recently we hit that high and are pulling back. Now this shaded area, if you take in consideration that this was where it tried to break out and had this massive failure here, one strong down week, this is an area, this yellow shaded area seems to be telling us that if we stall, that was a big down week. So this area seems to be a legitimate resistance level. If we can't hold above these levels, even the crude oil is going to be on a pullback mode. Take a look at the again at the weekly chart here. This big pullback that I'm showing here, this big failure on the USO corresponds to the RSI on the weekly chart stalling at this level here, which is exactly where it's stalling at right now. What that tells me is that we could see that the crude oil at about 110, 106 is as high as it's going to go, and the crude oil is going to be pulling back, with also the possibility of a market that wants to stall. Again, you'll notice that the Dow has only managed to stay above 13,000 only for one day, and since then it's been struggling to hold above that level. So even the Dow is showing signs of exhaustion. Now one more last chart, and this is the insurance sector monthly chart, and this chart seems to speak a lot to me, because you'll notice that since 2000 and let's say 2003, ever since we broke out here, we had a multi-year rally that took the market from about 2,400 all the way to about 4,400. So huge rally in about 3-4 years. Now we broke down here in a late 2007. Now you see that over the last couple of months we've tried to stay above this level here, but this month we're already pulling lower. So this might be a breakout failure here as far as the insurance sector is concerned. But really what is more interesting is that this failure here that took place in 2007 right there, that failure that led to the crash of 2008, 2009 is shown very well on the RSI. You'll notice that in 2007 here, 2007, we broke this trend line right there. That was a break. Now that break led to the crash of 2008. So now we've come back, we stalled on this level here. We stalled in 2011 and we had a big pullback. We are stalling again, or showing signs of stalling again here, beginning of 2011, which might suggest another pullback is imminent in the market. That being the case, we need to watch those levels on the Dow and the S&P 500 to see whether they're breaking out or failing. If they are failing, then you can be rest assured that we're going to be seeing a significant pullback in the stock market. This is Eric Muathe with Muathe.com. If you want to learn more on how to read the charts, on how I look at stock market analysis in the market, you can go to the www.muathe.com, click on the My Secrets tab, and take a look at what we have to offer in terms of free videos on how to explain most of these phenomena in the market. Eric Muathe with Muathe.com. Peace and blessings.